Hello friends, here we'll discuss the regulation and the compliance module A and the chapter legal framework of regulation of the banks. So in this chapter we'll be discussing what is the structure of this chapter. See, we are having objective, introduction, business of banking, constitution of a bank, RBI Act, then Banking Regulation Act 1949, Reserve Bank and the Reserve Bank as a central bank and the regulator for the NBFC, government as the regulator of the bank, control over the cooperative banks and regulation of a bank by other authority. Okay, this is the structure of this chapter. After that we are having some objective. So what is the objective of this unit? To understand the nature of the business of banking, the definition and explanation necessary to facilitate the understanding of what the techno legal statutory norms, the constitution of a different type of the bank, the regulatory scheme of RBI Act, the role of RBI and the central government as a regulator. Now see some introduction part of this chapter. See, banking in India is mainly governed by the Banking Regulation Act 1949 and the RBI Act, that is the Reserve Bank of India Act 1934. Okay, so the Reserve Bank of India and the Government of India exercise the control over the banks right from the opening of the banks to their winding up by virtue of the powers conferred under these statuses. What do you mean by it? Simply, very simple. In India, if we talk about the banking now, we are having two major acts. Okay, what is the first act? First is the Banking Regulation Act 1949 and second is the Reserve Bank of India Act 1934. Okay, so this is old act, RBI Act, and this is the Banking Regulation Act. So these two acts, Banking Regulation Act and the RBI Act, mainly regulate the banks in India, right? And through these two acts, the RBI, that is the Reserve Bank of India, and the central government, say Government of India, they exercise their control over the banks. Since opening of the banks means since providing the license, and since till what, till winding up means till closure of that banks, all the rights have been exercised by the either RBI and the central government. Okay, by how? By two acts called as the Banking Regulation and the RBI Act. Okay, now see, all the regulatory provisions are not uniformly applicable to all banks. See, this is no, there is no any straight rule that this rule is for this. Okay, so basically there is no uniformity for the banking industry. So you can see how the applicability of the provision of this act to the bank depend on its constitution, that is whether the statutory corporation, banking company or the cooperative society. So see, we are having different types of the bank. We are having the public sector banks, right? So we are having public sector banks. We are having some foreign banks are there, right? We are having the NABARDs, the banks like a NABARD we are having. After that we are having different cooperative banks. Okay, we are having different urban cooperative banks. So different types of banks we are having old private sector banks, new private sector banks. Okay, now we are having payment banks. So different banks we are having. So to regulate that, the provisions, whatever regulatory provisions, these are not uniform, obviously due to the variety of banks we are having, right? So that we have to discuss in this chapter. So see friends, here business of a banking, so see, what is the definition of a banking? See, what do you mean by banking? According to the definition, see, banking is defined where it is defined in section 5b of the Banking Regulation Act 1949. Okay, remember first itself the section 5b define the banking, and where you got the definition of banking? In the Banking Regulation Act 1949. What do you mean by banking? Simply, see, banking means accepting the deposit of money from the public for the purpose of lending or the investment, which is repayable on demand, otherwise withdrawable by the check, draft or otherwise. So what do you mean by banking? Simply, you take money from the people, right? This is the bank. Bank takes money from the people, and the same money bank lend as a loan to its customer. Okay, so taking money from public and giving that money as a loan to the public, this is what, this is the, according to the section 5b of a Banking Regulation Act, this is the banking. Okay, and see, another important thing, that should be repayable demand. That means once customer keeps his money with the bank, when he demands, you have to pay. When the customer demand his money back, the bank have to pay. See, we are having different balances, say current account balance of the customer. So customer when present check for you, that is counter check, self check, or otherwise the payable check. Okay, so that means you have to pay that money. Okay, so withdrawable by check, or he can even prepare the draft, or otherwise whatever the provision. Okay, so simply basic definition of the bank of the banking is what? Simply the bank takes money from the customers, right, and the same money bank lent as a loan to its other customers. Okay, and whatever the person keeps his money with the bank, that must be withdrawable, right? When the customer wants, he can take his money, he is right, it can withdraw by the way of check, or by the way of draft, or otherwise any medium. Okay, now thus the bank necessarily perform two essential functions. So we can say bank perform two functions. Okay, first is what? Simply accepting the deposit from the public and lending or the investment for offer such a deposit. That means first is take money from public, right, and the second is what? Give that money as a loan to the public. Okay, next, see, the deposits are made repayable on demand or after a period of time as mutually agreed by the banker and the customer. What do you mean by it? Repayable on demand or after a period of time? Simply see here, repayable on demand means what? Here you can say repayable on demand means what? Customer can withdraw his money by paying presenting the check, right? So if the balance in current account, he can withdraw anytime. But period of time means what? If he has done the fixed deposit for the period of say 2 years, then only after 2 years he can claim the money. Okay, if the period, if the deposit is locked, right, for say fixed deposit for tax saving purpose, right, which you cannot claim before the period of 5 years, right? So there is some period of time if deposit is having lock-in period. Okay, so this is mutually agreed by banker and customer. So when customer makes the FD, we ask him what is the period of, for that FD. So if say he said 2 years, that means we can lock it for 2 years. Okay, so very simple definition. In terms of the definition, the banker can accept the deposit of money only and not anything else. So obviously, right, so we are accepting the deposit, and as per the law, only money we can accept as a deposit. We cannot accept other things equivalent to money. Okay, only the money is allowed to take as a deposit. Now see, deposit withdrawable by check means what? See, under section 49A of the Banking Regulation Act, no person other than the banking company, Reserve Bank of India, State Bank of India, or any other banking institution, firm, or any other person notified by the central government in his behalf authorized to accept the deposits withdrawable by the check. Means what? See, you have to understand here the basic thing. Section 49A restricts other person accepting the money as a deposit. Means what? Only RBI, SBI, then other banking company or other banks are allowed to raise the fund from the public. Okay, so there will be a question, which section restricts to take money as a deposit for other than banks? So section 49A restricts other than banks to accept the money, okay, which should be withdrawable by check. Okay, see, who provide you check? See, check, only the banks have authority to provide the check to its customer. Okay, so whatever deposit the customer deposit, he can withdraw that check because bank only provide the facility of the check. Okay, and that is the provision under section 49A. Okay, now see here, acceptance of deposit by non-banking entity. Now see, there are some other funds, some cheat funds are there, some cooperative societies are there. How they can accept the deposit then? That we will discuss. See, there are also the non-banking financial company called as the NBFC, very much popular. NBFC nowadays very much popular. Nowadays NBFC means non-banking, but it is a financial company. Means what? The firm who accept deposit from the public. Acceptance of the deposit of a non-banking financial company is regulated by the RBI under the non-banking financial companies acceptance of public deposit directions issued by the RBI. So you understand here. See, banks are allowed to accept the deposit. Apart from that, NBFC, there are different NBFC who can also accept the deposit of a public. Okay, but you have to note here, it is not withdrawable by check. Okay, you understand here one thing. What? The deposit of NBFC is not withdrawable by check. The NBFC cannot provide you the check. The check facility is important, and check facility is only available in the banks under section 49A. Now you see, NBFC can also accept the deposit from the public. And how? Because the RBI has given them guideline in the NBFC acceptance of the public deposit directions by the RBI. RBI have given the direction under the title NBFC acceptance of the public deposit. Okay. Now, see, licensing for the bank. How bank can get license if you have to open the bank tomorrow? Okay, how can you open the bank? So in India, necessarily to have the license from RBI under section 22 of the Banking Regulation Act. So first understand which section gives you the license. Section 22 of a Banking Regulation Act provides the license, okay, for carrying the banking activity or the businesses. Now every banking company has to use the word bank as the part of its name. Now see, the banking company, say banking company can use the word name bank in the part of their name. For example, say Union Bank, Corporation Bank, okay, then Canara Bank. So these are the banking company which can use the word bank in their title, right? Now see other finance like Muthoot Finance, okay, they cannot use the word bank, right? So that basic difference you have to understand, okay. Now see, bank name can be used as per the section 7 of the Banking Regulation Act, okay, and section 22 gives the license for the banking business. Now further, no firm or the individual group of individual is permitted to use the word bank, banking or the banking company as a part of their name for the purpose of business, okay. So subsidiary of the bank, cooperative society of the public sector bank employees not being primary accredited society are exempted from this restriction. So see, anybody cannot use the word name bank, okay. I have already told you in the beginning, like Muthoot Finance, they cannot use the name like a Muthoot Bank or say banking or a banking company, okay. So the term bank, the name bank or the banking company is not allowed to use by anyone, okay. This is restricted obviously by section 7 of the Banking Regulation Act. Here it is specified who can use it, okay. So as a part of their name for the purpose of business, nobody can use other than the authorized entity, bank, banking and the banking company. These were to be used restricted as per the section 7 of the Banking Regulation Act. Now see, there are some exceptions like a subsidiary of the bank. Say State Bank was having the subsidiary like a Travancore Bank, right? So these subsidiaries of the bank, if there is subsidiary of the bank, then that can then they are allowed to use the word name bank. Now the cooperative society of a public sector bank employee. Now see, you are having different bank employees. We are the bank employee, right? If you are working in the public sector bank, we are having different credit societies, okay. So these society are also allowed to use the name bank, okay, but primary credit society are not allowed to use the name bank, okay. So these are some exception from these restrictions, okay. Now see, what are the permitted business? What do you mean by permitted business? Simply, permitted business means what businesses are allowed to do by the bank in India, okay. So some of the activity permitted under section 6/1 of the Banking Regulation Act. Section 6(1) of a Banking Regulation Act gives what the bank can do in the name of business, okay. So dealing in the bill of exchange, including drawing, accepting, buying and selling, okay. So basically what? Dealing in the bill of exchange. Apart from that, lending, the main objective of the bank, then carrying on the transacting every kind of a guarantee and indemnity business. So bank give the bank guarantee, bank also do the indemnity businesses. What is indemnity? We have to discuss in module D. Indemnity. What is guarantee? We have to discuss in again module T, okay. So the guarantee and indemnity, these are the basically contracts, okay. So bank also earns some money by the way of guarantee and indemnity. Selling the property which come into possession. So if any party does not repay that money, bank can take possession of that property and bank can sell that property. Okay, so this is what this type of activity are permitted to the bank. Okay, so which you have to remember, simply section 6(1) gives the list of the activity that a bank can do. Okay, now what are then prohibited business? That means the bank cannot do. Okay, so thing you have to understand which businesses bank cannot do. Okay, so section 8 of the Banking Regulation Act prohibits the banking company from trading activity. Okay, so bank cannot do the trading because bank is having lot of funds. Okay, 1,000 crores of rupees bank is having, lakhs of crores. If bank invest that money in the trade in the share market, then whole share market will be controlled by the bank. So trading is not allowed. Okay, buying and selling or the bartering of goods is also prohibited. So bank cannot participate, bank cannot work as the market, right? Bank cannot sell other goods or the other goods, right? Or even bartering is also not allowed. If bank started doing that, then who will do the banking, right? Okay, now see, important section 9 of the Banking Regulation Act. Here what you have discussed, section 8, see, you have to understand the important thing. Sections, two sections are also important. Section 8 is what? For stopping the bank from trading activity, right? And section 9 is important because this section deals with the disposal of the non-banking asset, provided that no banking company shall hold the immovable property. So you can see, if the now there is very much huge increase in the property. Okay, for example, it may be the land, it may be house, or it may be a commercial property. So you can imagine if bank started dealing in that, then bank can invest in different commercial property, and within through 2 year or 5 year or even 10 year, that the price gets double, triple, very huge increase in the price. You are very much aware, right? So you can see, that's why the RBI knows it very well. And section 9 of the Banking Regulation Act stops banking doing this, because if bank started doing this, bank will earn very huge profit. Then who will do the banking business, lending money to the common people, right? That's why it is prohibited. So section 9 of the Banking Regulation Act deal with the disposal of a non-banking asset, provided that no banking company shall hold the immovable property except for its own use. So immovable property means, say, land or the any house or the, say, commercial property. These are not allowed to be held or purchased by the bank. But if it is for its own use, for example, training center, if there is any training center, if there is any regional office, head office, for that purpose, if bank purchasing the property, then it is allowed. Okay, or any period exceeding 7 years from the acquisition thereof, such a property shall be disposed of within such a period. If the bank purchases any property, okay, and which is immovable, say land or the any house, right? So that property, if bank purchase now, within 7 year, bank has to sell it. Within 7 year, bank has to sell it. Okay, so you understand, banks are not allowed to purchase the property. If bank do so, within 7 year, bank has to sell that property. Got it? So you have to understand the 7 years are important. 7 years, because they can ask you a question based on the that year. Okay, for how much period bank can hold the property, immovable property? Maximum 7 years. Now see, the provided further, RBI may in a particular case extend the period of 7 year by not exceeding 5 years. So these 7 years are allowed, but if RBI find that yes, you are exception to this, then RBI can extend you further 5 years to retain that property, but beyond that you have to sell. Okay, so 7 year plus exception by RBI 5 years, so maximum 12 years you can keep. Okay, but RBI permission is required for 5 years extension. Okay, now see the constitution of the banks. Okay, so very much you are familiar with the constitution of the banks. So see, banks in India fall under the one of the following category. We are having category of the banks, right? Public sector, private sector, cooperative. So see, what are the categories? See, body corporate constituted under the special statute means what? See, very basic. See, special statute means what? Say RBI. Okay, RBI Act is there. NABARD. Okay, Okay, these are what created by special act. Special act is passed in the parliament, and then it is being created. Then public sector bank, these are also comes under the different act. One act ordinance was passed by Indira Gandhi in the parliament, then the public sector banks was created. So these are the banks which are created by special statute. Then company registered under the Companies Act 1956. Now it is been revised as a Companies Act 2013. Or the foreign company may be there, right? Then cooperative society which are registered as a under the central or the state government. Okay, so we are having different types of the bank. First is depending on the their nature, how it is being constituted. Then it may be come under the Companies Act 1956. Now it is 2013. Okay, or it may be the foreign company or the corporate credit society or the the cooperative banks. I can say cooperative bank. Okay, it may be under the control of central or the state government. Okay, now see one by one. Public sector bank other than the SBI. Okay, so means what? See, public sector bank other than SBI. So the public sector banks are constituted under the Banking Companies Acquisition and Transfer of Undertaking Act 1970. So you see, when and the Banking Company Acquisition and Transfer of Act 1980. What do you mean by it? See, you see here, in 1969 the bank nationalization was announced. Okay, so how it should be supported by some legal backup. That's why two acts were enacted in the parliament. First is the Banking Company Acquisition and Transfer Act. Okay, 1970 and 1980. Okay, because two times bank nationalization happened. That's why the two acts are there. 1970 Banking Company Transfer Acquisition and Transfer of Undertaking. Banking Company Acquisition and Transfer of Undertaking 1980 and 1970. Two acts are there because two times nationalization happens. Okay, now under section 3 of this act, central government nationalized certain banking companies. Okay, you are very much familiar, right? In 1969 initially 14 nationalized banks were taken control by the government and these are nationalized. Okay, so these have that happened two times in 1969 and 1980. Okay, so basically these are under two acts. Okay, how the public sector banks established you got now. See, State Bank of India. Now see, for State Bank of India, it was constituted under the State Bank of India Act 1955, while 7 associate banks were constituted under the State Bank Subsidiary Bank 1959. Okay, so 7 subsidiary, now it is being merged with the SBI. So friends, see here. SBI is constituted by the way of SBI Act 1959, right? And SBI's associate banks were there previously, right, which were now merged with the SBI. Say State Bank of Hyderabad was there, State Bank of then State Bank of Travancore was there. So these are merged with the SBI. So but that bank was constituted by the way of State Bank of India Subsidiary Act 1959. Okay, now see, what about the RRB? RRB means what? Regional Rural Banks. Okay, so see, RRBs were constituted under the Regional Rural Bank Act 1976. Okay, so these banks are governed by the statutes creating them, as also some of the provision of the Banking Regulation Act as well as the RBI Act. Okay, so you remember here when the RRBs was constituted in 1975 and by the way of RRB Act 1976. Okay, now see here. Now friends, see the ownership in the RRB, who have the majority stake in the RRB. So see, in the RRB, see the central government is having 50% stake, right? Then after that the 35% share is owned with the sponsored bank. Okay, say the bank which is sponsoring the RRB, and 15% remaining share was with the local state government. Got it? So who owns the RRB? 50% by the central government, 35% by the sponsored bank, and 15% by the state government. Okay, respective state governments. So indirectly you can say who is the majority owner? Central government, because the sponsored banks are also owned by the central government. Okay, so we can say these are what mainly controlled by the central government. Okay, now here you can see what do you mean by sponsored bank? Means this is simply the nationalized banks have sponsored the RRB. See, even alone SBI has sponsored around 14 RRB. Okay, SBI alone has sponsored 14 RRB. For example, say Chhattisgarh Rajya Gramin Bank or Jharkhand Rajya Gramin Bank, then Meghalaya Rural Bank, like that, Nagaland Rural Bank. So these are a different type of bank, okay, which have been around 14 are there RRB, which alone sponsored by SBI. Okay, so this is all about what the RRB. Now see here the private sector bank and the foreign banks. So now see, most of the private banks including micro and small finance bank are the companies constituted under section 3 of the Companies Act 1956. Now you have to understand here, the private sector banks are how registered? They are registered under section 3 of a Companies Act 1956. Now that Companies Act is what? Companies Act 2013. Okay, it is replaced. Okay, so 1956 was replaced by simply 2013. Okay, now how the banks are being constituted? Simply the same, most of the private sector bank are registered under section 3 of the Companies Act 1956 or say Companies Act 2013. So basically all the private sector banks are the companies. Got it? Simply. Now see, foreign banks are also basically foreign companies constituted under as per the status board. All the foreign company treated as a foreign bank which do the banking business in India are governed by the Banking Regulation Act and the RBI Act with regard to their business of the banking. So simply for foreign banks also, how they have registered abroad depends on their status. Okay, and if they are doing the banking business, we treat them the foreign bank. Okay, so what are the foreign banks? Say Citibank, right? So here say Citibank, we are having Citibank, which is the foreign bank. We are having HSBC. Okay, so these are the foreign banks. Then Standard Chartered Bank, so these are the foreign banks. Okay, then Sonali Bank. Okay, these are the bank from Bangladesh, right? So these are the banks which are the foreign banks. Okay, and for private sector banks, see, which are registered under Companies Act 1956 means say old private sector banks. Okay, old private sector banks means what? Simply say Federal Bank, South Indian Bank. Okay, these are what? Old private sector banks. And now the what is the new generation bank then? New generation private banks means like simply say ICICI Bank. Okay, then the HDFC Bank. Okay, so these are what? ICICI, HDFC, Kotak. These are what? The new generation private sector bank. And these are what? These are the old generation private sector banks. Okay, now further, cooperative banks. What do you mean by cooperative? Simply the cooperative banks conduct the ordinary banking businesses but established on the cooperative basis. What do you mean by cooperative? Means some people come together, say 10 people came together. They have contributed their own fund and they have started the cooperative bank, like that. Okay, so history of Indian cooperative banking dates back to the enactment of the Cooperative Societies Act 1904. So we are having here the Cooperative Society Act 1904. Now see, here see, you will see the structure of cooperative credit institution in India. Okay, so cooperative credit in India, see, we are having urban cooperative, we are having rural cooperative. Okay, understand the structure. We are having urban cooperative and we are having rural cooperative. Now urban cooperative, which is divided into two types: scheduled urban cooperative and non-scheduled urban cooperative. What do you mean by scheduled and non-scheduled? Schedule means these banks which are included into the RBI schedule, RBI Act 1934 Schedule 2, which are included in the schedule, or basically it is a list of bank. Okay, so these are in the schedule of the bank, so called as the scheduled urban cooperative banks. And the banks which are not in the schedule of RBI, these are the non-scheduled urban cooperative banks. So why scheduled and non-scheduled there is difference? Because see, scheduled banks are having some more rules. Okay, and that's why they have to keep some their additional money with RBI. So people consider if the bank is scheduled, that means it is more secure, more safe. Got it? So we are having scheduled and non-scheduled urban cooperative banks. Okay, now scheduled urban cooperative, we are having again two types: multi-state and single state, means operating in more than one state, operating in only one state. Okay, and for non-scheduled we are having again multi-state and the single state. Okay, now come to the rural cooperative. For rural cooperative we are having two types: long term and the short term. Okay, for long term we are having SCARDB. Means what? The State Cooperative Agriculture and the Rural Development Banks. Okay. Further, we are having what? We are having the primary. We are having primary cooperative agriculture and rural development bank, right? For a short term, we are having state cooperative banks, then DCCB means a district cooperative banks, and the primary agriculture credit society. Okay, these are generally for the short term lending. Okay, so we are having the this is the structure of the cooperative credit institution in the India. Okay, so you don't worry about the structure. Okay, it is just for your understanding. Okay, but some full form you can easily remember, which are important. For example, PACS, primary agriculture credit society, then DCCB means simply the district cooperative central bank, then the PCARDB, then SCARDB. Okay, this full form you should remember, so that if there is question you can easily understand it. Okay, structure you don't need to mug up. Okay, don't mug up. Okay, now see the here, if a cooperative bank is operating in more than one state, that is a central act, that is a multi-state cooperative act is applicable. See which act to be applicable to which cooperative bank is also important. If the cooperative bank is operating more than one state, say Kerala plus Tamil Nadu plus say Karnataka, right? Then more than one state, then to that bank central act will be applicable. What is central act? Multi-state cooperative society act. This is the central act. Okay, multi-state, because this is operating in multiple states. Now, if a cooperative bank led to the failure, say PMC Bank in Mumbai, you are very much aware, right? That was lot of roar during that when the PMC Bank failed in Mumbai. That was one of the biggest setback in the banking industry, because this Punjab and Maharashtra cooperative bank, this is one of the very much famous bank, right? But that collapsed in 2019, and which led the government of India to amend the Banking Regulation Act for increasing the power of the RBI for the better regulation. And thus, the Banking Regulation Act was amended by the Amendment Act 2020. Okay, and this was amended through the parliamentary provisions. Okay, now see RBI Act. So here we will discuss the RBI Act, that is the Reserve Bank of India Act 1934. So this act was enacted to constitute the Reserve Bank of India, with the primary aim of what? To regulate the issue of banknotes and keeping the reserve with the view to secure the monetary stability and to operate the currency and the credit system. So why the RBI was set up initially? Only first purpose what? There should be one regulator for banknotes. Okay, there must be a monetary stability. For that purpose RBI will work, and for the purpose of currency and the credit in the bank, there must be a regulator. Okay, so for that purpose mainly RBI was enacted in the beginning. Okay, now the act deals with the power and the function of the Reserve Bank. Okay, so this act gives some power to RBI, because it is what? It is the act which constituted the RBI. Section 42, which provide the cash reserve for scheduled banks to kept with the Reserve Bank. Okay, so here what do you mean by cash reserve? Cash reserve means say CRR, cash reserve ratio. It is now say 4%. Means what? If a bank is having 100 rupees, out of that 4 rupees must be kept with the RBI. This is what the cash reserve. This is what the cash reserve. Okay, and this is according to section 42 of the RBI Act. Okay, and which bank? This is mandatory. This is mandatory only for the scheduled bank. I already told you in the previously, scheduled bank. That's why people say scheduled banks are more safe. Okay, so only scheduled banks are required to maintain the CRR as per the section 42 of the RBI Act. Apart from that, section 18 of the RBI Act provide for direct discount of bill of exchange and promissory notes. Okay, so this is provision under section 18. Now, acting as the lender of last resort is also one of the important role of the RBI. The RBI may act as the lender of last resort as per the provision under section 17 and 18 of the RBI Act. So here, what do you mean by lender of last resort? Means what? See, you have to understand here. See, 3-4 sections are important. We should understand how the RBI act as the last resort under which section? Section 17 and 18 of the RBI Act. Okay, CRR need to be maintained under which section? Section 42 of the RBI Act. Section 18 provide direct discount for the bill of exchange as per the RBI Act. Now, what is the bill of exchange permission? No, that we have to discuss further. Okay. Now here you have to understand what do you mean by the last resort. Last resort means what? If all options are closed, only last option is remaining. Okay. So that time bank will be helped by RBI. First bank will try all the options. Okay. And if any bank is not getting the resolve the issue, lastly they will go to RBI. Okay, and RBI will act as a lender of last resort. That means RBI will provide something help to them. Okay, by the way of loan. Okay, now see amendments to the RBI Act with respect to the NBFC. Now see, major changes are there. Limit of net owned fund has been enacted to enhanced to 100 crores from the existing limit of 2 crores. See, there has been some changes in the RBI Act with respect to the NBFC. Okay, so NBFC's net owned fund, how much NBFC can keep net owned fund? Maximum limit now it is increased to 100 CR. Okay, it was previously only 2 CR. Now RBI has two ways to control the management of the regulated NBFC. By either RBI can replace the director of NBFC or RBI can suspend its board itself. Okay, now RBI has given the power to remove or debar an auditor also from exercising his duty as an auditor or from RBI regulated entity for a period of 3 years. Okay, so RBI has power to debar or remove the auditor who is doing audit. It is for the period of 3 years. Okay, so you can understand it. Okay, the power of RBI. Now RBI gives power to frame a scheme for amalgamation, reconstruction, or even a splitting of the NBFC. Now see, we are talking about the major changes. First, owned funds can be kept up to 100 CR. Then RBI can replace the director or even suspend the board of director of the NBFC. Now RBI can remove the auditor of NBFC for the period of 3 years, and RBI also has power to amalgamate or do the reconstruction or the splitting, that means division of NBFC. Okay, RBI has this power also. Okay, RBI has also been given power to direct NBFC to furnish the statement or the information relating to its group company or order of inspection or even for the audit. That means basically RBI obviously is having that power, right? RBI can ask NBFC, submit your audit report, submit your inspection report, submit the information about your group of company, submit the different statements like what is your monthly transactions, like that. Okay, so different statements, different audit report, different inspection report that RBI can ask to NBFC. Okay, now these are what the power of RBI with respect to NBFC, major changes. Okay, so friends, here we'll stop. Remaining part will be discussed in the next video. Meanwhile, you can subscribe us on the YouTube Banker Zone. You can download the application Banker Zone, link is given in the description. This is our group for CAIB discussion. Okay, so this is our group for CAIB discussion. You can directly search CAIB Banker Zone in the Telegram to join the group. Otherwise, you can directly search @CAIB BZ. Okay, now this is our official channel recently launched for the JIB CIB, where you can find the notes. Okay, so Banker Zone Official is the name of the channel. For that, you can directly search @Banker Zone JIB CIB. That should be without space. Okay, so thank you friends. We'll continue our discussion in the next session.